Welcome, ladies and gentlemen, to Lesson 9, Responsibility Accounting and Decentralized Organizations. In this lesson, we're going to learn how management analyzes performance in a decentralized organization, understand the different methods of calculating ROI, and understand how management monitors performance using the residual income method. Alright, to start, let's have your Lesson 9 cheat sheet in front of you. It's only one page, so have that in front of you. We're going to start at the top. Under concepts and definitions, we're going to go to decentralized organization. Decision-making authority is spread throughout the organization. That's what a decentral organization looks like. Decision-making authority is spread throughout the organization. A centralized organization, decision-making authority is limited to a few top executives. So all the decisions are centralized with a few top executives versus a decentralized, it's spread out. All right. A cost center. A cost center, a segment whose manager has control over cost, but not over revenues or investment funds. A profit center. A profit center is a segment whose manager has control over both costs and revenues, but no control over investment and funds. An investment center, a segment whose manager has control over costs, revenues, and investments in operating assets. All right. So that's what a decentralized organization is. That's what cost centers are. Let's look at the organization chart that we got given here at the top right, top left corner. We've got HMS Roundbelly Inc.'s organizational chart. We've got at the very top corporate headquarters, president, CEO. Underneath them, we've got operations, finance, legal, and human resources. We've got the chief operating officer, who's in charge of operations. Under the chief operating officer, there's like the sailboat product line, the aluminum boat product line, the accessories product line, and under each product line, let's go over to the finance first. Under finance, we got the CFO, the chief financial officer. Under him, there's the accounting department. And then under legal, for the purposes of this demonstration, we're not putting anything under legal, but there's people under legal. Under human resources, there's people under human resources. Let's go back to operations. So we have these different product lines, and under each product line, I've only illustrated what's underneath the aluminum boat product line, but assume that under the sailboat product line, there's a similar branching out, and under the accessories product line, there's similar branching out. Okay, underneath the aluminum boat product line, and this is going to be true for each product line, there's a product manager, and under the product manager, there's a production manager, a warehouse manager, and a distribution manager. And under the product manager, there's these different production, warehouse, distribution managers. Under the distribution manager, under the production manager, there's production workers. Similarly, I haven't illustrated it here, but under the warehouse manager, there's going to be warehouse employees. Under the distribution manager, there's going to be distribution employees. Going over to the accounting department, under this chief financial officer, there's the controller. Under the controller, there's accounts payable and accounts receivable. There's other functions within the accounting department, and I've only illustrated these, but this is how a typical organizational chart looks, but with only specific things highlighted. Anyway, what I've done is I've highlighted what are investment centers, profit centers, and cost centers. All right, so an investment center, we look at corporate headquarters is an investment center because the president and CEO is going to make decisions about revenues, costs, investments, and so is the chief operating officer. The chief operating officer is going to make decisions about how to operate the business, how to increase productivity, how to increase assets, how to increase sales, how to decrease costs. So the investment centers are located at the corporate headquarters and at the operations level. Now, a profit center, right? Remember the definition. A profit center is a segment whose manager has control over costs and revenues. So profit centers, we got the sailboat product line, the aluminum boat product line, and the accessory product line. So we've got actual profit centers, and those are product lines. So the product manager has decisions over revenues and expenses. The product manager comes up with what the sales forecast is, and then he also comes up with the budgeted cost of goods sold with the help of the production and warehouse, distribution, and sales and marketing. So those are profit centers. Then we've got cost centers. Cost centers, if you remember the definition, a segment whose manager has control over costs but not revenues or investments. Finance, they're controlling costs, but they're not selling anything. They're not investing, right? Legal is a cost. They have control over how many employees they have, what type of litigation they enter into, how they outsource that. Same with human resources, how many people have, but they have no impact on investments and they have no impact on profit or revenue. So the cost centers, similarly, underneath a profit center and an investment center, we have different cost center. Like a production manager, he can only control his costs. He can say how many workers he has, but he can't control how they're going to invest the funds in the production department. He can't say how they're going to increase sales in the production. He's only in charge of the cost. So the difference between the cost center is the cost. These people, like accounts payable, or the controller, he's in charge of the accounting department cost center, but he can only control the cost, not no revenues or investments. Whereas at the profit center, they can control the revenues and costs, but they can't control the investments. Whereas in the investment center, they control everything. That's why you're talking about investment centers are high up, profit centers are in the middle, and the cost centers are down below, except for those SG&A, right? Selling, general and administrative, that's where finance and legal are going to come in. They're below the line. They're operating expenses. They're not producing goods. They're not producing revenues. So those are all cost centers. All right, that's what that's what an organization looks like. And so then it's decentralized because the different product managers can make decisions about revenues and expenses. And so then how does management monitor how these people are doing? Management monitors how the different profit centers are doing and cost centers by something called ROI. So what is ROI? ROI, down here on the right, is a net operating income divided by average operating assets. Any increase in ROI must involve at least one of the following: increased sales, reduced operating expenses, or reduced operating assets. ROI is a measure of performance, and it's one of the key tools that management uses to measure performance. Let's go through some different definitions, and then we'll get into some examples. Business segment. Business segment is a part or activity of an organization about which managers obtain cost, revenue, and profit data. Cost, profit, investment centers are business segments, right? We just went through the investment center, profit center, cost centers. Those are different segments. They can be considered different segments of a business. Also, sales territories, investment centers, individual stores, service centers, marketing departments, individual customers, product lines can be considered business segments. And it's all really dependent on how management tracks and how management monitors the business. Let's go over to responsibility accounting. Okay, responsibility accounting is a system of accounting that links lower level managers, these guys down here at the cost center and at the profit center. It links lower level managers decision-making authority with accountability for the outcomes of their decision. A responsibility center, a term used for any part of an organization whose manager has control over and is accountable for cost, profit, or investments. The three primary types of responsibility centers are cost centers, profit centers, and investment centers. That's what we went through. So in a decentralized organization, you have all these different centers, business segments, and management needs to monitor how those doing. And the typical way that management monitors those is from ROI, or residual income. Residual income equals net operating income, which is equal to net operating income or earnings before interest and taxes, or EBIT. And subtracted from that, you get subtract from that average operating investments time minimum required rate of return. That's an equation. We'll go through an example. ROI, we got the equation there. It's net operating income divided by average operating assets. And then we got the DuPont method of ROI, which is operating income over invested assets equals sales revenue over invested assets times operating income over sales revenue, or ROI equals investment turnover times profit margin. Segment reporting involves measuring the profitability of a business segment during a given period. Traceable costs that exist because of a particular business segment and would appear and disappear over time if that business segment itself disappeared. Common costs that because of the overall operation of the company, and costs that because of the overall operation of the company would not disappear if any particular business segment were eliminated. These are like accounting, legal, human resources. If we got rid of the accessories product line, those common costs would still be there. Transfer pricing, this is a concept. We're not going to get into examples, but just understand the concept. Transfer pricing is the amount charged when one segment or division of a company provides goods or services to another segment or division of the company. The fundamental objective in setting transfer prices is to motivate managers to act in the best interest of the overall company. There are three primary approaches to setting transfer pricing, namely negotiating transfer prices, transfers at the cost to the selling division, and then transfers at market price. Basically, transfer pricing is, say, the accessories product line was going to, the aluminum boat product line was using some of the accessories, like say, accessories produces oars, right? So they manufacture oars, and we can sell oars, wooden oars as accessories. But the aluminum boat product line uses oars in the finished good, so that when you buy a boat, an aluminum boat doesn't come with a motor, but it comes with oars. So the accessories department transfers those oars to the aluminum boat product line. Well, how do they transfer them? Well, they have to attach some cost to it, right? And transfer pricing is saying that in order for the accessory line to be monitored correctly, they can't just give it away for free. Then that would drive down the net income of that product line and to make it look worse than it really is. They need to attach some cost and some profit before they transfer to the aluminum boat product line, so that it more accurately reflects the activity of that product line. Okay, let's get into some examples. Let's go over here to the middle of the page, the left side. ROI examples, given information. So this given information is going to flow through all of the examples, well, 1 through 5. So we got HMS Roundbelly Inc. reported the following results: net operating income of $45,000, average operating assets of $300,000, sales $750,000, and operating expenses of $705,000. 1. Roundbelly Management calculates ROI as follows. So let's go through the ROI equation. ROI equals sales revenue divided by invested assets, or average operating assets, times operating income divided by sales revenue. All right, let's plug the information, the given information, in the equation. ROI equals $750,000, which is our sales, divided by the invested assets, which is $300,000, times our operating income, which is $45,000, divided by sales revenue. That gets us $2.50 times 6%. That equals 15%. That's our that is our Roundbelly's ROI. Now, 2, use the given information at 1, so the sales revenue information. Use the given information at 1. Assume Roundbelly Management was able to do the following: increase sales to $900,000, while operating expenses increased to $837,000. B, increase net operating income to $63,000, and no change in the average operating assets of the segment. Well, let's see what that impact had on what the impact on ROI was. ROI, the basic equation, we got sales revenue divided by invested assets times operating income over sales revenue. Plug in the new information. We increased sales to $900,000. Invested assets stayed the same. Operating income was increased to $63,000, and our new sales revenue amounts to $900,000. So that equals $3 times 7%. That equals 21%. So that increased ROI because we were able to increase operating profit. Use the given information at 1. We'll go over at 3 now. Use the given information at 1. Assume Roundbelly Management was able to do the following. A, reduce accounts receivable by $50,000 by shifting staff to increase collections. Well, what's that going to do? That's going to decrease one of our denominators, invested assets. That's probably going to drive up ROI, right? Return on investment equals $750,000, which is our sales revenue, divided by $250,000, because we reduced the $300,000 by $50,000. So that gives us $250,000 times our income, $45,000, over sales, $750,000. That gets us $3 times 6%. That equals 18%. We increased ROI by 3%. 4. Use the given information at 1. Assume Roundbelly Management was able to do the following. A, invest $45,000 in a piece of equipment that increased sales by $47,500 while increasing operating expenses by $24,000. Okay, so a couple things going on. Let's plug everything in the equation. Return on investment equals, so sales revenue, we were able to increase sales revenue by $47,500. So our new sales revenue is $797,500. But our invested assets increased, right? Because we now invest $45,000 in a new piece of equipment. So our invested assets increased from $300,000 to $345,000, and our operating income also increased, but it increased the difference between our increase in sales and our increase in operating expenses. So that difference is $23,500. So you take our original $45,000 plus the $23,500. That gets you a new operating income of $68,500 divided by our new sales of $797,500. That equals $2.31 times 9%. That